Investing in innovative technologies. It's going to be the focus of anyone trying to benefit from the energy transition, and even far beyond the move toward net zero, which is the thesis behind my channel, but just in general. Especially in 2021, there was a new SPAC emerging what seemed like daily. But where have all those stocks ended up now? We can see the state of that trend just by looking at the ARK Innovation ETF run by Cathie Wood, who is famous for investing in what seemed like disruptive, innovative, and many times unprofitable companies. So what lessons can we take away from that? And is investing in innovative technology actually a good idea? Well, ARK originally benefited from a trend that's no longer popular, growth over all cost. A lot of the companies in her fund had pretty good or great gross margins, so the original business model is seemingly good, but they stretched themselves thin and overspent to grow as quickly as possible. You'll especially see this with companies like DraftKings, who are massively overspending on marketing to gain market share in the online gambling space, while this sector is still in its infancy in the United States. So the problem Cathie has now is that while these businesses were technically good when looking at their margins, they're deeply overvalued and incinerating their cash for the sake of growth. You'll often find that there are far too many competitors in these emerging and hot sectors, so it can be difficult for them to reduce costs and actually reach profitability. In doing so, they would risk losing their market share to competitors. In many cases, unless a company has an existing moat that would give them an advantage, seeing their slide deck with a section on how massive the total addressable market, or TAM, of their sector is actually a bad thing. This just tells us that there's going to be plenty of competition to deal with. The company you choose to own in these sectors won't be the only one that sees the potential for growth here. If you want to invest in disruptive companies, it can actually be better to focus on companies disrupting unpopular or typically low-growth industries, where the upside is either not immediately obvious or there's some barrier to entry keeping most people out. That explains some of the stocks that I own personally, but I have plenty of videos discussing those companies. So I wanted to focus on some interesting small cap companies working to contribute toward the energy transition, and some potential reasons behind their recent shortcomings. And this would be Origin Materials and Hyllion Holdings. These are companies that went public through SPACs, just like many of Cathie Wood's companies, but they can't spend nearly as much as her companies can. They don't have tens of billions of dollars to throw around without a care in the world, really. So cash burn matters here, especially when the global economic outlook is not nearly as rosy as it used to be a few years ago. So starting off with Origin Materials, I made a video on the stock previously, but never bought in, and if you'd like to watch that, I'll link the video in the description below. But this is a company that's trying to find new ways to make plastics sustainably, particularly by using plant or organic-based substitutes to replace the hydrocarbons in the production process. So petroleum is out, and feedstocks like wood chips will be used instead. But the company came out on their conference call for Q2 2023 to say that there were some changes coming to the commercialization plan, to say it lightly. And these are notes on the call from D1 Fund on X. Their Origin 2 facility, set to be their first commercial-sized plant, was originally going to be completed in 2025. And then they go on this call and say that it'll be fully ramped up by 2028. That's a delay of approximately 3 years. Nearly all their financial projections worsened significantly. The revenue target's lower, EBITDA is lower, margins are lower, CapEx increases by $500 million, and knowing how building out large-scale production facilities tends to go, there could even be more delays, and they could easily end up going over this budget. And to top it all off, they're starting off the facility by working with biofuels instead of their plastics alternatives, so they pivoted the products being manufactured as well. This was just a total shock for investors and not expected in the slightest, and as a result, the stock price collapsed over 50%, rightfully so, and has basically been dropping since. At its peak, the company was valued at $1.8 billion, and now we're sitting at a market cap of approximately $150 million. With around $200 million in current assets as of June 30th, the stock is valued at or below cash. But the question is, how the company is going to be able to fund themselves to ultimately build their commercial facility. We'll talk about some takeaways from all this after we go over Hyllion's situation. And as we move on to Hyllion here, who recently announced some potentially deal-breaking news, you'll find this is another company in similar circumstances. Hyllion is a company looking to disrupt the long-haul trucking space, with their primary product, the Hypertruck ERX, fueled by renewable natural gas, said to be sporting multiple superior features over traditional diesel trucks. And there were also hybrid and fuel cell models as well. The other product that Hyllion has, the Carno generator, which they acquired from GE for a total value of $37 million at the time. And the main appeal of the stationary generator is that it's fuel agnostic, meaning it can use hydrogen, natural gas, propane, and a variety of other fuels. In addition to being more efficient than leading generators through the use of 3D printed components. This acquisition also made it possible for Hyllion to add this generator onto their ERX trucks, so that made it incredibly versatile. Promising technology for sure, but all the company's progress came to a screeching halt when they recently came out and announced the need to explore strategic alternatives for their electric powertrain business, aka the Hypertruck ERX. Hyllion is currently pausing new orders for the ERX and grappling with a lack of demand for their trucks, which the company blames on uncertain market conditions. And this might not be the end of the company, as they're still working to commercialize their stationary generator, the Carno, but there are plenty of questions in the air, like the obvious one, what's the company going to do now? And the main appeal was the electric trucks. No one was buying this company for the Carno generator, especially when the potential of the generator on its own can be a little questionable when GE was willing to give it up. Hyllion has around $250 million in current assets as of June 30th, and the company lost around $38 million last quarter. At its peak, the company was worth $7 billion in market cap, and after the announcement about pausing production and exploring potential alternatives, the stock was down to around $130 million. Now, yet again, Hyllion's being valued below its cash on hand, like Origin, but at this point, the future of the ERX and Hyllion as a whole is uncertain. And we see issues like what Hyllion and Origin are facing pretty frequently with these types of companies that are trying to innovate. So how do we try to mitigate the possibility that we find ourselves in situations like this? It's ultimately impossible to never own a company that fails. It's highly unlikely. But what are some of the best signs that we can avoid to improve our odds? The first thing, like I mentioned earlier in the video, finding companies that are innovating in traditionally slow industries can be increasingly ideal. But the company you're buying needs to have some type of moat behind them, and that's the crucial caveat here. The legacy automakers are being disrupted by EV companies, but most of them make for terrible investments because scaling up production capacity, charging networks, and building out vehicle models is extremely expensive and time-consuming, in combination with no auto company having any real moat to rely on. With both Hyllion and Origin Materials burning tens of millions of dollars per quarter now, I would surmise, for many of the companies like these, that the problem is not investing in development of innovative technology on its own. The problem is the capital intensity of many of their business models. How expensive it is to scale to profitability is a primary concern many of these companies face, and that should be the point of focus for early investors. The larger the scale required, and the more labor, and the more capex, the more likely you are to see budgets go over expectations and delays to occur in time frame. The ideal scenario, in my opinion, to invest in are companies with business models that are capital light, so you don't need to burn tens or hundreds of millions or even billions of dollars to reach profitability. Combined with one reason or another, why the company you're buying will not see a significant level of competition. The companies that Cathie Wood has been buying are capital light. Many of them are software companies, but the stocks she buys have a variety of competitors, and many of them don't have great moats. On the other hand, a company like Hyllion has to deal with competition in the trucking space, and the business model is capital intensive as well. You don't see great gross margins in the vehicle production business, so this is a lose-lose, and it makes things difficult for early investors who are essentially just hoping Hyllion will be able to scale up before they run out of money. The situation for Origin is similar, but with better expected margins, business model-wise, but the TAM is so large that the competition is less relevant for now. There's so much potential market share available that the main concern for them is really just getting their costs and timelines under control. The stock would be a lot more enticing if they could license out their technology to have other companies build out their commercial facilities instead of doing most of that work themselves, but they haven't really been able to prove their technology to begin with so far. Ultimately, both Origin and Hylion are where they are now because scaling up in capital-intensive industries is difficult and costly. But all of what I've said so far in this video describes what industries or business models to not invest in. So which ones should we focus on exactly? So I would argue that we should focus on capital light and high margin opportunities. None of this is to say that low margin businesses can't do well, but if we want the best chances of success, it is likely best to avoid them. This channel is focused on investing in companies that will provide services that benefit the environment in some way. So many of the best options would be in areas like software, commodity exchanges, financial products, technologies with licensing potential, so they don't incur all the costs of building out large facilities by themselves. So if these companies are unprofitable right now, that can be more manageable. Burning a few $1,000,000 per quarter or less instead of tens of millions while they scale to profitability. Many of the companies in the green space, if you will, are going to be unprofitable right now. Many of them are also going to be small companies. And the world hasn't truly been focused on trying to combat climate change for very long. So the key here is to buy companies that have the potential to build out quality business models while burning as little investor capital as possible. A large aspect of ensuring that they spend sparingly is through high levels of insider ownership, which is another good attribute to look for. But I digress. If you'd like to hear more about some examples of companies that fit this criteria in my opinion, and ones I own myself, then I'll link to a video on the comparison of my stock portfolio and the attributes of successful companies in the book 100 Baggers by Chris Mayer, and that link will be in the description below. Thanks for watching.